Live streaming is on.
All right, good afternoon, everybody. We are getting ready for the latest version of the Sentiment and Flow Show, and it certainly comes at a pretty interesting time as we've got just about 2 weeks of trade left. Markets are having a pretty difficult day, so today's discussion should be pretty pertinent to what we're looking at in with the backdrop that we're operating on in both the sentiment and flow data that we see coming out. But we're going to be bringing in at this time, Brett Manning, also known as Chart Trader, who is about as good as you could get in terms of reading markets, looking at charts, and understanding the data that we are about to discuss. So, we are taping this show for anybody that might be missing it. You'll be able to listen to it later, or if you got to bounce out in the middle. So, without any further ado, Brett, how are you doing today?
I am getting better.
That's
Um,
good.
it, I mean, I've been kind of half present for a lot of action lately because I went straight from COVID to influenza A to pneumonia. So I've been sick basically for 2.5 months. But over the last week, I think I'm finally getting to where I'm consistently back at full gear. So,
Is it kind of a long COVID?
well, no, I mean, I was diagnosed with influenza A right after being diagnosed with COVID,
Oh wow!
like
So
like
so
three and
they're
a half weeks
separate.
later. And because they were both lower respiratory, it kind of conflagrated into pneumonia. So it was like 10 weeks straight of being sick. It's really
Yeah.
awful to go through.
I would say so. Well, it's good to have you back here today and to kind of give us a hand in wandering through these markets and trying to figure out exactly what's going on. So, let's talk about the last 18 hours or so, as that's going to be pertinent to this conversation. Naturally, we had the Fed yesterday, and another hawkish message from Powell as he continued to try to hammer home the higher for longer. The Fed signaled that they were planning on being aggressive. I thought in the outlook for the Fed funds futures, where they had us at about 5.1% terminal rate for 2023, followed by a 4.1% rate in 2024, which were both elevated from the prior levels. Now, I was keeping an eye out on that 2023 rate with 5% was kind of my break even point where I thought if it was 5%, that would be right in line with consensus. They came in a little bit higher. And then they, of course, followed that up with the dot plots, where 17 of the 19 members of the committee saw rates going above 5% next year. So, wanted to get your basic thoughts on that 2023 outlook that the Fed has.
Yeah, I mean, I think as I wrote yesterday late and again this morning, I think that the part of the discussion that was most interesting is the difficulty in trying to tamp down inflation that's ultimately rooted in a tight labor force. And that there's just going to be a lag to that, and we're starting to see that with CPI the other day. We saw an improved number on every level except for the service side, which was worse than expected. And right before that, we had the jobs data where we saw that huge jump in wage growth. And I think that that's what the Fed's focused on, and I think that that's why they're. I don't think that they're just bluffing. I think that they are seriously contemplating that they may need to go higher than they thought and keep it higher for longer because they've got to battle that. And I think that's one of the main reasons why we saw the reaction that we did and why we're seeing what we're seeing today.
Yeah, which certainly makes a lot of sense. So it was interesting to see some of the initial reactions and yields yesterday as they continued to slip lower. My take on that was simply the idea that I don't think it's as much as people think that the Fed is going to has a plan to lower rates next year as much as they think that they're going to cause a recession that's going to
Sure,
force them to. And that was kind of my take on that bond action. Would you be in line with that?
absolutely.
Yeah, so it's been one of the things that's really been sticking out. Even looking at the Fed funds futures, you got the feeling that the markets simply don't believe the Fed's going to be able to be as aggressive as they want to be. Now, I know we've heard a lot of talk about Powell and company wanting to create a soft landing for the markets. Do you think that yesterday's conversation kind of turns that away a little in terms of they might be a little bit more settled on the idea of causing a a quick, deep recession in order to rein things in.
Yeah, I mean the model that I look at And I've said before, I think it's kind of the analogy would be cancer therapy and chemotherapy and radiation treatment. Like the cancer is inflation, and if you have the radiation and chemotherapy hurts the body, but it kills the tumor, and they want to kill the tumor before it metastasizes and turns into stage 5 metastatic cancer everywhere, right? And that's when you see a shift in to carry the analogy further. That's where you see a shift in inflation expectations on the long term, and you no longer have any kind of basis for price stability. So they're willing to take us down deep in a cycle if it means that they can kill the tumor completely. And I think that again, if they see the sticky side, and we saw the mentality shift after we got that wage growth number back to being a little bit more hawkish. And I think that's the battle. And I think, yeah, I think that they're perfectly willing to push us into recession, even if it's not just a shallow recession, to accomplish
Right.
that job.
And when we get into the econ data in a second here, I got a few things I don't want to throw at you. But ECB, Bank of England, they also followed up with 50 basis point rate hikes. And I saw some people couch the Bank of England rate hike as being dovish, I guess, because two members voted for no change in rates. Did you have any thoughts on the BOE or ECB decisions, or is it just you're looking at it as the three biggest central banks in the world, all in a pretty aggressive tightening phase right here?
Yeah, well, and I think I think it feels to me like a situation where they've got further to go. And I think we hear that a little bit, and certainly Japan too is going to be, I think, just kind of embarking, right? I mean, suddenly Japan
Yeah.
inflation's ticking way up. So I think you've got this sort of, and we're going to talk about the dollar later, but you can see this sort of cycle timing aspect to FX trading, which is always kind of a major part of the game. And so the U.S. is going to be kind of, the first through the process of pivoting, and then you're going to see probably Europe and the Bank of England, and then Japan last.
Yeah. Well, I guess Brazil technically was the first to pivot, and I know you with your emerging market um,
True.
calls have definitely been watching that. So that's certainly another area that we're going to be looking at. I think it sets up as a nice 2023 play. But then, so we got the information from the Fed, and that certainly raised a red flag. But then I think the econ data that was out this morning really doubled down on the worst aspect for the markets. And that was, we got that poor retail sales number that missed expectations. The Empire manufacturing fell short of expectations. So did Philly Fed. I mean, sentiment data in general has been pretty weak as of late. But then we got the claims number
Right.
outperforming, and we followed that up with the industrial production number coming in a little light. So it's really the worst case scenario for the markets. And I think
It's
one of
kind of a
the
microcosm of what we were just talking about. Yeah, you get this poor performing economy with a tight labor force.
Right. And I guess that's what I wanted to throw at you because even the jobs component of the Empire and Philly were stronger compared. We were seeing weakness in the pricing components. But let me ask you this, Brett. I think this is going to be the toughest thing for the Fed, and I'd be curious as to your thoughts. I've seen a lot about people not we know how tough it was to hire people a couple of months ago, and that still seems to be the case. We see the JOLTS numbers continue to remain high. Heard lots of anecdotal evidence about people just simply not able to find workers in 2022. Now we're in a position here where the Fed's trying to kind of choke off some of that workforce there. But what I've been seeing a lot is people dragging their feet and not really looking to lay off workers for the simple idea. Number one, it was tough to find them. Number two, you got to go through the whole training, and people simply don't want to just go through that training under the idea that we could be looking at a 2-quarter recession at the beginning of the year, and then general expectations are for things to improve. But it's going to be tough for things to improve if the Fed's going to continue to remain aggressive because people simply aren't laying others off. Now, we kind of also saw that, right? We saw a growth in hourly earnings in the jobs report, but the average work week declined. We saw initial claims come in cool. But the components that we were seeing in the Empire and Philly in terms of average work weeks and everything were seeing a little bit of weakness. So we're seeing people getting paid more and working a little less. And that's going to, from my perspective, Brett, that's just people not willing to let go any employees. So again, it points to the idea. Do you think that the Fed just has to go a little bit deeper just in order to unearth some of those companies that simply don't want to drop employees?
No, right. I mean, it's the traditional problem, and it's hyped up even further because there's sort of this game theory landscape that's set in play by the shortage of workers. But the other thing you have to realize is that so while people are going to be, and I think you're exactly right, they're going to be reluctant to lay people off until they absolutely have to. But also they're going to stop hiring new workers at a certain point, and that shifts the kind of power relationship between employers and employees because you're getting these wage gains because employees can leave and get a job that pays them more. So once we take that out and the inflation rate goes down, then at least you're going to stop the wage growth. You won't have to pay people more to keep them because they don't have the ability to go get a job somewhere else quite as easily. Um, and maybe even we see pay cuts as a way to keep employees who don't want to lose a job and not be able to get another job, and who don't see the same inflation numbers. Um, and I mean that's possible as a way to kind of an alternative to seeing major layoffs. But yeah, I mean I think that people who've taken this long to build up a workforce and right they've invested in training um, and in many cases just recently are going to be reluctant to fire people, and it's going to need to be a sort of necessary uh, element in terms of survival.
All right, let's take a look real fast, Brett, at the continuous contracts for the S&P and Nasdaq. Then I want your thoughts on what we're seeing. I got the charts here. You tell me what time frame you would like to discuss this in.
Well, so I actually, I posted a chart a little bit ago. I don't know if you saw it.
I did not.
Okay, check the 1123 comment, and it's easy to see. I just drew it. I mean, it's a type specimen broadening triangle that we've seen over the last close to a month, and the bottom level, the bottom sloped support, which is sloping down because it's an expanding triangle, comes through right now, right about where the continuous contract 50-day moving average is. And I think that that's a terrific target in the 38.75 area.
All right, let me just pull this up real quick.
Yeah.
All right.
So there
we go.
That's a broadening triangle.
Okay, and that's the level that you're watching right there.
Well, if you see where the bottom line intersects with the market, today,
Yeah.
tomorrow, the next day, that is right where the 50-day moving average is on the continuous contract on the cash S&P. So there's a confluence there. That trend line. It's also just it's a break under a flush under the shelf support for the range that goes all the way back into November. So
Right.
you flush that out, you get down to that bottom line right at the 50-day, maybe overshoot it a little bit, and that's probably your first main area of serious support.
Do you have any plans to do anything around that area?
I mean, whatever setups I see. I mean, if I see a setup that's compelling, I'll be willing to short even how far down we are, as long as I see the type of bulls battling to hold and the lead blanket offer coming down on top of things. Going long in that area, it depends on how it feels. It depends if we see a real flush out as we go there.
Okay.
A lot of extra volume added.
All right. Well, we'll be keeping an eye out here on the markets as we're talking, but we're going to break into our presentation right now, Brett. So let's take a look at some of the sentiment and flow data that we are seeing out there and how that factors into the price action that we're monitoring, as well as any potential trades that we might have. And the first thing up, of course, is we always like to take a look at the AAII data. And this is The most recent numbers were released this morning, of course, coming in at 24.3% for the bullish figures, 31.1 for neutral, and 44.6. As we could see from the prior week, a small decline on the bull side, bigger decline on neutrals, with them primarily completely moving into the bearish side of things. So we've got the bull number at the lowest level since October 5th. And then the bear number that would be at the highest level since November 9th. So looking at it on a 4-week average, you can see clearly in bearish territory there. And one thing that I would note, Brett, is we had a lot when we did the show in September. The bullish sentiment was actually much lower than where it is right now. So, do you find that as room for a little bit more people to get bearish in here? How are you interpreting this AAII data in terms of a potential bottom?
Well, I mean, to me, there's a time element that's important with this particular indicator. So it's 25 and under is sort of fair game. It's a bear market overall environment, so you'd want lower, but it's the consistency. It's seeing it in that zone for 3, 4, 5 weeks, and especially if you start to see, moving averages of that, where we get it. In, the term that I like to use is festering. It's festering in that sort of asymmetry relative to long-term averages. Then people. Then it translates into your sense of how people are positioned. Um, and this is a reasonably good indicator, I think, of larger kind of active market participants. And being 13, 14 percentage points under the long-term average in terms of the number of people who are bullish is a significant amount, and it means people are already assuming further downside and they're not long, which means, again, sentiment data is always about this. There needs to be some kind of catalysis involved. There needs to be something that causes people to change how they're viewing, and then when they're leaning too far, when they're too under position, then there's a huge scramble. We've seen that a couple times over the last few weeks. Obviously, when Powell did his Brookings Institute speech, and there was that lack of hawkish rhetoric, and it seemed like he had stopped trying to bang the market down. With the Nasdaq was up 5%. We've seen a couple versions of that where you see people scrambling in because they're caught too flat. So it's, it's already there. I'd like to see a little bit lower and a few more weeks of it to get really confident of that, but it's not by itself a signal to do anything. It's just it's it's a representation of a state of affairs that favors one thing over another in terms of where the risk is. The risk, if it festers here much longer, the risk is to the upside.
Um, do you have an issue with anything that went on between Brookings and this meeting in terms of kind of like the misdirection, or do you just think it was simply, had 2 weeks of a quiet period and things had just changed that markedly that Powell kind of shifted focus? Not that he did so much of a 180 pivot, but he definitely was. I don't want to say more dovish, but his tone was different within that time frame.
Yeah, there's a I mean, I don't know if this is true, but I wonder if you're the Fed and you're in this really difficult position. I mean, really, like, if you it's got to be really tough to manage the communications knowing how people are going to react. And it, I don't know whether I really believe this, but it's not impossible that he's kind of setting people up a little bit to have, you know, to be wrong-footed, to pour in and then get burnt, just because it's going to make it easier to communicate for them in the future.
Yeah, yeah.
I mean, like, he didn't say buy stocks, right?
Oh yeah, yeah. No,
He didn't
yeah. He
he's not
didn't come
blame
out
he's
saying
not to be
assets are
blamed,
cheap and stuff. Yeah,
right? But if he's just a little bit like, if he's not Jackson Hole whacking everybody on the head every sentence, and everybody interprets that as some big bullish signal. I mean, I'm not sure whether or not maybe it's helpful for them to let people have that experience, to not stop it, to not fight against it, and then to let them get burnt a little bit,
yeah,
just to stop that kind of crack addict instinct.
yeah, yeah. No, good points. So, Moving along, taking a look at the data. Obviously, we're talking about the transgression where the historical averages are. You could see, obviously, well above. Usually, it's a 13% difference in that bull and bear activity going on. We're well off the bearish highs, which would have been 60.9% back on September 21. And then the bullish highs naturally were pretty far off. That would have been last year around this time on the 29th. So it's been a pretty weak year on the bullish sentiment, that's for sure. Moving along, here's the 8-week moving average, and this is what I was kind of looking at, Brett. We really haven't seen much of a change in sentiment over the last couple of weeks. You can see we've basically been running in that 25% range for 6 weeks running. This is after we'd been running around 24% back in October. So the expectations have been markedly steady, considering how bearish things are. I'd be curious as to other time frames when something like that has happened, but certainly been a while. And,
Yeah.
and, and you can see the decline from the summer when we were running closer to that 28, 27 area. So do you see anything notable in this data?
No, I mean it's good perspective. Um, but it does show that we've just been so completely, overwhelmingly pessimistic for months. And
Yeah.
of course we have. I mean, it's the when we came into this year, the reason why I turned so bearish in December and January, just it's just an unwinnable situation for the market, or at least it certainly looks that way when you have a situation where you know that you're losing the safety net that you've had for a decade and a half, which you get with a deflationary or highly disinflationary environment where every time assets get weak, the Fed can step in and do something, and that's the safety net. That and the the fixed income flows that come across when you get the dividend yield above interest rates. So you charge interest rates higher, and you take the Fed, and they're willing to hike right into a market crash. That's a difficult thing to be bullish about.
Yeah, and been evident in the sentiment data, that's for sure. Um, Taking a look, Brett, I know one of the things that you've been focusing on is the put activity in the small traders. So you have a chart up here, small trader put buying, just kind of highlighting how aggressive this has been. So any comments on this particular chart here? I know you've talked a lot about the kids with calls thing, well, not kids with puts, obviously, in this
Yeah.
particular view.
Well, I just think it's interesting. I mean, look where we are. The uppermost red line on that chart, we're most of the way. It connects back to where we were most of the way through the pandemic crash, and we've been sitting at that level of small trader put buying, for a couple months, and we're right there right now, and we've been making higher highs on this. It's just interesting perspective. I mean, people are just speculating like crazy on the downside.
Well, the option activity's just been pretty busy in general, and we'll talk
Yeah,
about some of that going on. This was the chart that I came across with Goldman Sachs, and one of the things that I thought was interesting was the discussion. It's not just the retailers that have picked up the options trading, but a lot of institutional investors doing more options trading, particularly in short-dated option contracts. This is the volume of that going on, and I think one of the parts is I would be curious to see, but I would think we've probably set a record this year for the most 2% moves that we've seen in the history of the markets, because it's pretty common to see big 2 to 3% moves on a daily basis right now. So obviously this factors in here. How does something like this impact your trading style, would you say?
well, I don't know if it really does. I mean, I think what one of the things that you're seeing here is just, I think that the options market is just evolving into a more mainstream thing. I mean, liquidity begets liquidity. If there's more people involved in it, your executions are better. You have less risk in terms of exit risk at any given moment, where you could just see a liquidity hole. Like, it's becoming such a thriving market that's there's no reason not. You get extra leverage there. I think it's just becoming what it was destined to be, and it's a younger market than shares. So I think it's just kind of arriving. Um, I don't know
You
if
think
there's.
a lot of this is the new age trader basically
I think it's
coming in?
yeah. I think
Yeah.
it's just when it's. I mean this level of volume and liquidity is improves everything about interacting with it.
Also, it sets forth, I would say, the use of Python and other programming languages for writing these programs.
Absolutely, absolutely,
That's got to factor into a lot of this liquidity as well, too.
sure, yeah. But otherwise, I don't know if it really impacts much of anything about the pattern structures or anything like that.
Well, for me, I guess it kind of impacts it on terms of the strength of the move or the weakness of the move. I feel like we're much more likely to overshoot on things given this type of leverage than we would have primarily been ready for back in the day, and seeing moves erased or built pretty quickly. So, it's just for me, things are faster paced, and that's obvious in this leverage and the
Well,
amount
but
of.
we are in a bear market. You're going to have wider ranges. Like the volatility is just higher, right? I mean, I don't know. I don't know if just. I mean, leverage doesn't have to do that because people can trade smaller size. They just want this instrument rather than shares. If they're trading, if they're over leveraging their capital regularly, which maybe that's happening, but it's not necessarily the case. It could just be a different mode of interacting with the market.
Right,
Um,
and the bearish activity certainly leads to some bigger moves. I will agree with you on that, but I don't know. I'm just, for my mindset, I think you kind of have to have the idea that things could overshoot more than your targets and undershoot a little bit more because of this type of leverage that's out there.
it's
Is
possible.
is basically the point that I'm kind of looking at as I see some of these options data, and we'll show you some more options data at the end, just to kind of talk a little bit about, because we do have quad witching tomorrow, and of course we had the VIX options expiration yesterday morning. So all right, let's break into the Bank of America Fund Managers survey, Brett. First, we're going to talk about each one of these in depth, but some of the things that were jumping out to us here, just as kind of an intro. 69% of people were expecting weaker global growth, but pessimism stabilized around the China reopening. CIOs, they're pushing a lot more for CEOs to concentrate on balance sheets. 90% of investors predict lower global inflation in 2023. So, some of that's certainly been priced in terms of the expectation side. Cash levels, they dropped to 5.9% from 6.2%. And that's one of the things I wanted to talk with you about, Brett, in terms of positioning. Investors, they say government bonds will be the best performer in 2023. We're also seeing people the most overweight bonds since 2009. So we'll talk a little bit about the return of the 60-40 formula. The highest expectation of the U.S. dollar depreciation since 2006, a trade that might have already occurred, and we'll talk about that. We also saw a number of people talking about December short covering that had gone in, and then equity allocation in December being the highest since June of 2022. So we're going to talk about each one of these subjects here and take a look at some of the accompanying charts that are going around with it. So let's take a look at some of these data points, Brett, and kind of point out some of the more interesting aspects of each. Okay, so the first item we have up here is stocks versus bonds, and FMS investors seen bonds as the best performing class in 2023. Expectations for lowest rates, highest since March 2020. So when you're seeing this kind of factor in, uh, what do you think about that? Because obviously, with those low rates, expectations being the highest since March 2020, people are expecting a recession. So, how closely are you looking at the fixed income side of things, and are you taking any action in it too?
So first of all, I mean, this is your cycle rollover chart, right? And it's certainly
Right.
different from what we saw in either the previous instances shown here, especially in 2008, because you're not coming from this real inflation fight. So you've got arguably much better value in the bond market if you're heading into a period of disinflation and slow growth. So I would expect this to be a continuing theme. And I mean, and look at we saw the 210 yield curve more inverted, I think, than at any time since 1982. So
Yeah.
I mean, the expectation is super clear right now, and this feeds over into the dollar. I came very close to getting long TLT a few weeks ago when I got long silver and EEM, and in retrospect, that was a real bad miss on my part. But I don't know how we're going to get a chance at it where you can figure out where your risk is.
All right, hold on a quick second, Brett. Somebody's telling me that they're not getting this audio. I was hearing it before. Test 1, 2, 3. Yeah, well, good thing we're recording this, Brett. So
That
people
comment was right when we started.
Yeah. Okay. All right. So yeah. So everybody should be fine. Thanks. Getting some feedback here that that we're okay. So, but okay. Yeah. So, sorry about that. But I was just trying to take care of that issue while you were talking. But so stocks versus bonds. We'll continue to watch that playing out, moving along. The growth expectations, Brett. We've talked about the pessimism that's been abound all through 2022. There are some signs that this is bottoming, though, as evident by the recent replies from the fund manager surveys over the last couple of months. It's just been trending along down at that minus 40% area there. But then, we're also watching the S&P, which is trying to find a bottom. And as you can see, that percentage expecting a stronger economy has definitely been a fair leader of the S&P. So how are you viewing this data in terms of the price action that we're seeing in the markets?
Well, one thing I'd say is you can see really one of the things that you can see most clearly about this chart is that the year-over-year S&P change ends up troughing after. So just like you said, the expectations of a stronger economy tends to lead, but that would suggest that if this is the trough in terms of expectations, the market's headed further down.
Similar to what you could see
Every
in
instance here.
that June 2008 period, being
Well,
a clear
and
one for
and
sure. Yeah, September
2001 and
2000. Yeah.
even a small amount 2012, 2016. The turn just
So
happens later.
that would certainly
2018.
have you cautious then, given what we've
Well,
seen
just
here.
I mean, from this perspective, there's a pretty decent sample size here. So if this
Yeah.
is turning, it just tends to the expectations of a stronger economy shifting. It clearly has. I mean, this is data that's tough to argue with.
Yeah. So let's kind of keep this in mind, especially as people are
Now, it is year
getting.
over year S&P change, which can
Hey,
be a little bit like if the year ago is in an uptrend, then the market could stay right here and that line would dive.
right, because you could argue if you're looking at the biggest declines on a year-over-year basis, you'd have to go back to that November 11 drop, which would be the one that we didn't really see the S&P bottom after the growth expectations, right?
Sure.
So that's one factor, I guess, that we'll be keeping a close eye on, see how that develops. All right, moving along. Earnings expectations. Obviously, this factors in pretty keenly into the valuations. Now, I would say this, Brett. I follow all the guidance, all the earnings, post on it regularly, and we haven't seen them quite fall out of bed yet. Now, naturally, when the more we get some of this weaker econ data, then that's probably going to cause people to reassess things. But as you can see, the S&P Forward consensus number there, it's still running a little bit it's just kind of starting to get down towards that break-even point. Now, the net percentage of corporate earnings that people think will improve, that's at its lowest level, I think, in the history of this chart, going back at least through 2006. Perhaps it had topped out on 2001. But how are you viewing earnings expectations? I mean, for instance, we got Micron, Nike, and Nvidia out next week. What would be the red flags that you would have a concern about coming from them?
Well, I mean, I just assume that people are going to adjust worse, right? I mean,
Right.
it always happens that way. So, like, we're going to probably whatever we're at now, the expectations are going to gradually get worse into somewhere Q1 to Q2 of next year, almost certainly. So it's difficult to. I mean, that's the basis for being bearish on the market. But then again, we've got the sentiment data problem, right? Where
Yeah.
how much is the market really discounting right now? But I think what did I see yesterday? We're still at like 19 times, right?
Yeah, obviously down a little bit from that to after today.
Today, yeah, right.
But yeah, we were trading around. I think the 40-50 area is 19 times, 41.50 comes to just about 20 times. And you definitely have seen valuation being a very key decision maker in terms of longer term money, and people simply aren't looking to buy anything at 20 times. And you can't blame them in this environment. So
Well, it's
um,
interesting with that much negative positioning and that much cash that the market's at that level with earnings expectations declining.
do you think that
That's
speaks
a
to
difficult one to work your head around.
Do you think that speaks to leverage around that options trading, perhaps?
I don't know. I mean, I'd have to think about it, but it's like something doesn't really fit
Doesn't
together
add
well.
up. Exactly. Could it be just the simplicity that maybe we have to change the dial on the historical um, valuations in terms of like maybe 19 starts becoming the new 15 because of the amount of liquidity that's been pumped in over the last 10 to 12
That's
years?
very possible.
Because I mean, obviously, it's going to be something that we're watching closely. Because I see a lot of people arguing historical data,
Me-
but you know,
Another way to say that, by the way, is
yeah,
inflation.
yeah, yeah. No, inflation stocks are definitely an inflationary tool, right? So,
Yeah.
it seems to be pretty evident in the valuations that we're seeing. How long that lasts is naturally the question.
Right.
Uh, Moving along, a self-fulfilling prophecy, Brett. And this is one of the things that I've found pretty interesting. I saw it a lot. I was on a number of the calls on the Goldman Sachs Financial Services Conference, you know, JP Morgan, American Express,
Yeah.
all the big hitters. And they were talking about the price action and the loan demand that they're seeing out there from their customers. And they were talking about the knock-on effects where if you see one of your customers pulling back on their spending because they're concerned things are going to get bad, then you're going to develop less of that product, which naturally works its domino theory down around the global supply chain and everything. And it really feels like, and I actually did a check for Google Trends on recession. I didn't find anything all that particularly interesting, but I was curious to see if we saw instances where how often talks of recession pre you know, previewed an actual recession. And I'd be curious as to your take on that, because obviously when we're looking at this particular chart here where we see recession odds are peaking, at some point that factors into the decision making. It works its way into the real world. So is that kind of how you're looking at this particular chart? Do you think people are kind of talking themselves into a recession at this point?
Do I need to put a picture of a turtle up? Like I've covered this like 50,000 times. That's what
Yeah.
every cycle is. This is what every cycle is. The turtles control the weather doesn't control the turtles. Turtles going into their shell causes it to rain.
Yeah.
That's what every cycle is.
And that's exactly what we're seeing play out here. Obviously, we're starting to get up towards the high end of it now. It's just a matter of um, finding that actual data. One of the things that are jumping up with that too, Brett, and I know you talked about this in the prior sentiment and flow shows, where we usually run a chart that shows what CIOs want CEOs to do with the money, either improve their
Right.
balance sheet, make purchases, or do buybacks, dividends, capital return programs. The improving the balance sheet has, you said this 2-3 quarters ago, where when we see the improving the balance sheet outpace the capex spend, that's when you got to raise a red flag. And you can see that happening right there at that trend line
Right.
where that rose above. So, you know, a push to improve balance sheets definitely shows as part of that turtle, right? Going into the
That's
shell.
exactly right. Yep.
So, this chart definitely kind of highlighting some of the action that we're starting to see play out in
Which
economic
is what the
data.
Fed wants exactly.
Yeah. Yeah. So, that is working it in line. Uh, China comeback, Brett. Now, this is an interesting story. We're going to get a little bit deeper into China later. I know you have your EEM play out there. You were one of the first people in there looking around that softer dollar and looking for emerging market plays. I've got the FXI out there. Certainly, the reopening is coming into play, and I think that's pretty evident in that spike that we're seeing from November to December. So, how do you view the China COVID policies? And we're going to build on that just a little.
Well, I mean, I think it's just been disastrous. Their path on this, to me, has just
It,
been disastrous. And I mean,
it
just
really
looking
is 3 years in, too, if you think
3 years
about it.
in, and they still have very little immunity.
Yeah.
And and maybe it's just like the hospital infrastructure just wasn't there, and there was just too many people and too few healthcare resources, and not purchasing and importing massive uh, 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 Pfizer and Moderna vaccines, and instead having one. I mean, I think the one they're using now is calibrated for the first version, the first strain of COVID.
Yeah.
I mean, and like it just
It,
it,
it doesn't surprise me that I mean, we got people here that think the government's trying to track them with the vaccines. I can't imagine what they think about in China. So,
yeah, but they've got a command economy. I think they just thought they could do it. Like they can tell people to do something, and people have to do it.
yeah.
Like we can't really hear, so they went down that road, and authoritarian governments don't change well. They don't pivot.
Although
They've got
they're
no
authoritarian,
accountability whatsoever.
they're authoritarian, but it is interesting to see that they are afraid of upsetting the older populace, who are the most anti-vaccination from what I've seen, and that was
Okay.
one of the reasons why they dragged their feet. So I thought that was interesting. But obviously, when you start seeing scenes like we did a couple of weeks ago at iPhone City, with people just simply
Right.
having enough of being locked down in draconian measures, it's kind of forcing the hand at this point, and that's why you see that improved uptick in China. But I guess the key thing for China, and I had it saved later, Brett, but we might as well keep it on target here. And Pat was asked about this. Do you find the China reopening inflationary or disinflationary?
Do I? Oh, well, so
What's your thing? So obviously on the inflationary
it
side, you're going to get that demand for commodities coming back as they reopen, and there's more of a need to
yeah, no,
um,
I totally understand, and I think it would be deflationary ideally, if what it really means is that at the base of global supply chains, things are truly opening up and functioning better. I think that massively counters the increased demand for raw resources. Personally, I they've built up a surplus in just about everything, and they are disproportionately embedded into the base of so many different important global supply chains. So I think that the one overcomes the other. The question that I have is, do they start to reopen, and then they have such a massive COVID wave that they're crippled by it, and the hospitals are overflowing, and they have to go right back into lockdowns everywhere. Like I wonder if they haven't built up such
the
a
herd
problem
immunity.
now. Yeah, I mean, like if they'd spent their time in zero COVID and lockdowns, building tons of new hospitals and importing tons of mRNA vaccines, and vaccinating everybody massively, like versus having a lower vaccination rate. And I mean, I don't know where their healthcare infrastructure is, but I haven't. It's my understanding that they haven't necessarily massively expanded on a per capita basis. So you know, I think they just thought that they could just extinguish it, that everybody else it would gradually go away and not become endemic in the global human microbiome, and that they could wait it out and just keep people locked down until the threat was gone, and that did not work. And now I feel like they built up such a problem that it could be. I'm really not sure what's going to
So
happen if they
so
really
you
are
don't
forced to reopen by populist.
you don't feel as confident about the China reopening then?
I feel
Would
like
that be
it's
fair?
a big question mark. I feel like they could be forced to open, because they really have to. They really, at a certain point, they risk I mean, we've seen it in China before. Like you risk a popular uprising that takes out the government on some level. And like your power is absolute until it's totally absolutely gone. And so they have to in some sense respond. And if people are this sick of it and they have to open up, I wonder if there's just a ticking time bomb under the surface there in terms of what they're going to have and just an explosion of COVID cases. Maybe not, but I think it's a question mark.
So okay, so you give that a little bit of a higher probability than the market's probably pricing in right now.
Right. I think that overall probably it can be managed. I do think it's a question mark though.
Okay, fair
Which
enough.
I would send them right back into tons of lockdowns, right?
Yeah.
And then totally, rethinking their entire strategy.
Okay, so one strategy that you'd maybe have is if you were long some of these Chinese names having some sort of downside put protection.
I guess. Yeah. I mean,
Yeah.
I would think that I have to work through the implications of that,
Okay.
but I suppose that'd be part of it. I mean, there'd also
Yeah,
be,
no, that
the Fed's put in more of a quandary, and the
yeah,
whole.
no, that's interesting, especially given your backdrop with the understanding of medical procedures and everything. I hadn't heard too much about fears about that rampant spread that was just going to knock them back into lockdown. So something for us to watch. Unfortunately, we don't get really any accurate data on
Yeah, right,
hospital stays
right.
and stuff, right? So.
But I think, yeah, at a certain point, you'd
Any
start
thoughts
to.
on the China economic data? I mean, markets barely reacted to it. Obviously, it was pretty weak, but you think
Very
that was
weak.
pretty much expected at this point, and people think of that as a low with the idea that they are reopening next year?
I think, there's the bullish view, which is they are reopening next year, and also they're going to do a bunch of stimulus.
Yeah, yeah,
And
yeah. The two combined, right?
yeah, and then you get a weak dollar too, and it's a whole new world.
All right, moving along. Speaking of the dollar decline, and one of the things that I thought was interesting, and we're going to come across this chart, is how bearish people are on the dollar. But feels to me like a lot of that trade's already been priced in at this point, Brett. So you follow currencies pretty closely. Where do you stand on the dollar price action right now?
I mean, I think it's remarkable that we dropped down to that 105 area on the Dixie and then just ground through it.
Yeah,
Because that was such a level, right? I mean, there was a big range floor there. There was the 200-day rising MA. There was, this long-standing bull market first pullback to a big support level and didn't bounce at all. Just went sideways for a few days and then plunged through it. And that was an interesting thing to see.
do you think a lot of that has to do with the idea that maybe people just see the ECB and BoE playing catch up and
Well, it's yeah, cycle time.
tighten a little bit more in cycle timing, like you're talking about with the Fed for kind of first in, one of the first in. But you would think that there'd be a little bit more buying of the dollars as a protection if people were that concerned about the economy, don't you?
That's an interesting question too, right? Is it the safe haven in a global recession? I don't know. I mean, unless we're going to be first into recession.
Yeah. Well, I mean, Europe's pretty much
Yeah,
already in a
right.
recession,
Yeah,
right?
right,
So
right.
it's just about how deep they'll go.
But
But
yeah,
uh,
well, and now I guess the idea. I mean, they've got sort of a revision toward it's going to be less deep than we thought a couple months ago, from what I can see.
So, what do you look at any particular areas in the dollar and target wise in terms of, obviously you got that 100 psych level there. That's still a ways off. If we're looking at this on a monthly, I see 101.60 is the June lows. 101.29 right there is the May lows, and that was before we got that big pop back in big pop in actually I'm sorry, that's June lows, the big pop in May up through that level. What areas are you watching on the Dixie that are going to raise red flags for you?
I think I mean, the level that I'd see 102, 101.50, right in that area. I mean,
Okay.
you got a peak 103 coming from back in March 2020, but during the COVID initial crash. So you've got that 101.50 to 103 area because you've also got a range low from May of this year, right in that same area. So I mean, you've got a lot of levels, and then there's obviously 100 below that.
Okay. Moving along here. Peak inflation expectations, Brett. We've been talking a little bit about that. You can see here, look at net percentage expecting high shorter term rates. That has been dropping lower. Net percentage expecting higher global CPI. That's way down about that 90% level. So, which is the lowest since 2001, of course. Um, how are you viewing this data? Is there anything jumping out? It seems to be pretty much in line with what we've been talking about, right?
Oh yeah, I mean it's a chart of sentiment around inflation, and you can see hence the rally we just saw in equities, hence the turn in the dollar, hence the turn in bonds. I mean it's just a picture of everything we've just been talking about.
All right. Cash levels peak. Now, this is interesting because this is one of the things that we talked about. People are bearish, but not as bearish as we saw back in September and some earlier in this month. Positioning as well, these cash levels declining from 6.2% to 5.9%. Do you think these are the people that Powell's trying to kind of play a little whack-a-mole with and knocking them back onto the sidelines with that cash?
Yeah, maybe, except if you like this isn't much of a peak. Like we're
Right.
way above the long-term average. And, we've seen real peaks where, it goes from 5.8% to 4.3% in a week. Like this is basically we're still at 6% cash. That's still way over the long-term average. So people are still sitting on a giant pile of cash. I
What
mean,
is
we,
the
we
long-term
waver
average? Like
around that area.
4.3?
What's that?
Do you remember what the long-term average is? Is it like
4.
4.3? 4. Okay. All right. So you're hardly calling this a peak then, right?
Well, I mean, it did tick down, and
Uh,
maybe it's going to tick down a lot.
yeah.
I just don't see it. I just, look at what the market's doing today. I mean, and the other thing is that you may be transitioning from cash into bonds now because we really didn't have that 60/40 model situation viable, right? Risk parity was dead
Yeah.
when the Fed's hiking. So now suddenly recession expectations shift that picture a lot. You can put all your money in bonds, or at least so we think, and rather than just sitting in cash. And you've got, I mean, the 1 year's 4%. So like you get real returns in bonds just on the coupon. So it's a different world when rate expectations have shifted. If people thought rates were going to 6%, 7% on the 10-year, this cash thing would be people would just be in crazy amounts of cash because I mean that's the model, right?
Yeah.
You're waiting between stocks and bonds, and it's a weird period that we've gone through right now where you're taking money out of both stocks and bonds and just putting it into cash. So it means something a little bit different right now than it has over the last 10 months or so. But it's still almost 6%. Just people are still holding on to lots of cash, and I would expect that to go down, but probably into bonds.
Yeah. Yeah. Not moving into the equities for sure. All right, risk appetite. We did see very similar price action here, Brett, where people have been a little bit more willing to take on risk. And again, this kind of factors in everything that we've been talking about.
Yeah.
So, where is the risk in terms of out there in the market? I was surprised to see U.S. shadow banking really taking over China real estate, and this is probably some of the cockroaches that are being scared out from the Fed movement. I've been saying for years now that fintech is really the area where you got to worry the most about. And that has now passed China real estate as the big level that people are looking for. I haven't really seen much evidence of it, though, on the credit side. Banks were talking about that. Starting to see some signs here and there. Certainly the FTX news is probably raising a little bit of concern around leverage. But do you got any thoughts on this U.S. shadow banking response?
Well, so I think this is one of those things like we talk about with the sort of so what we saw in British sovereign debt market, right, and the relationship with pension funds, that there's when the tide goes out, you find out who's not wearing a swimsuit, especially when you've gone through a decade where you've got a lot of people who are really used to low interest rates and a lot of leverage, and just finding, you know, some kind of small edge and then levering up on it 20 to 1, 30 to 1 to try and turn that into a major annual profit, right? I mean, that's been the model we've lived in since pretty much 2008 until this year. And you've got a lot of people managing a lot of money who are just used to that kind of process. And I think that there's so many things that are underneath the surface across the entire financial system that are going to be exposed and broken by this type of shift, especially if we start to see a new wave of risk aversion. And I think shadow banking falls right into that category.
Yeah, and I continue to remain cautious on fintech names like Affirm, Upstart, PayPal, Square,
Right.
that don't have the experience, that don't have the fortress balance sheets that the banks do. I think you're
They're
going to
not evolved into the niche of the world that we have right now. They're
correct.
evolved into the world that we had, 2 years ago to 10 years ago.
And it'll be interesting too where the unemployment situation hits as well. Or is it going to be in some of the lower end jobs that might be more apt to work within a firm or something? So this is going to be something that first half of the year, if the Fed does do its job in stamping out some of that wage inflation, that you're going to see a lot of pain. And I think at some point you're going to see these banks really picking some of these names up for pennies on the dollar.
Sure.
Moving along, bonds are back. We've been talking a lot about this. Investors expect government bonds to be the best performer. As we said, they are outpacing stocks. Government bonds outpacing corporate bonds too, and outpacing commodities by a fair amount. Cash and naturally crypto running at the end there. Anything on this chart that's jumping out to you?
Yeah, no, I mean, I can understand where people's minds are at here. I guess, you can look at what the possibilities are if they're wrong. One way to be wrong is that the Fed is pivoting too early. I mean, yeah, I'm not saying that that's what's happening. I'm just saying it's a possibility in the spectrum of all possibilities that the Fed ends up taking their foot off the gas pedal on hikes, and then we see 9% CPI in April or something, and how do you protect against that possibility? As just, even if it's a 10% possibility, what does somebody do? And I guess commodities would be that.
Yeah, and never have we seen the new normal go back to the old normal with the investors overweight bonds for the first time since April of 2009. So popped 10% overweight compared to underweight of 19% from the last reading.
Right.
Commodities being shunned here, Brett. Obviously, growth concerns factoring in. This is the most
Sure.
underweight commodity since April 2009. Uh, would a China reopening provide opportunities? Is the question here. And the other thing that I've seen too is a lot of concerns around supplies and inventory levels on some of these commodities. So, what's your outlook on commodities for 2023?
So I think 2023, I think that there's a really interesting, very long-term structural opportunity over the course of the next year or so. Um, I think that you're looking at a world where we've underinvested in fossil fuels massively for the last even 15 years. And our ability to produce energy through alternative sources of energy is going to fall short for 20 years into the future of really being able to take up much of the slack. So on a long-term structural basis, so if you see recession, particularly a global recession, and we see commodities really underperform, like there's an argument, and look at copper. And now I think Goldman Sachs just raised their 2026 target for copper to like 11,000 a ton in London, like new all-time highs by a lot, because you need it for, well, let's say like the entire infrastructure around alternative energies. And we were supposed to be investing in lots of new copper mines over the last 2 years, and nobody really did. Um, so you've got this, I don't know, you've got this really long-term structural problem in terms of supply of really important major industrial commodities. And yet, yeah, the environment is perfect for, you know, people who are long those, giving up on those positions for at least a period. If we're heading into global recession, Fed tightening, the cycle is all, on a cyclical level, it's all against commodities right now, but on a structural level, it's just the opposite. So there may be a really interesting opportunity next year for a really long-term bet.
All right, so we'll be watching commodities closely. Crowded trades, obviously a big drop off in that long US dollar. It's still the most crowded trade out there. And short China equities was the second biggest, which is interesting again, given that move that we've seen long oil kind of holding steady there. So, um, my assumption with China of reopening is fears around regulatory action still remain, and then perhaps there are more people than we suspect that are kind of in your camp about this reopening, Brett, and how smoothly it could go.
Right. Now, I think it's interesting that long US dollar is still the most crowded trade.
Given
And
out
yet,
big
in the same
pullback.
survey, the highest percentage of people in the survey's history believe the dollar is going to go down.
Yeah,
Some
the
interesting.
disconnects there, right?
It seems to be. I mean, there may be a lot of people who are not long the dollar, but think everyone else is, and they've got a contrarian short idea.
Yeah. And any ETF trades off that you'd be looking at or anything, or
Off the dollar.
yeah,
I mean, it's just not acting well. I guess I'm still bearish the dollar, but the way that I've been trading that is through
long
EEM and
EM and
SLV.
silver. Yeah.
Yeah,
So and again another boost to your commodities there, right? So
right.
sector allocation, no surprise, very defensive here. Bonds, healthcare, staples, cash being the top. Commodities coming in at number 5, and then equities way down as people have been shunning them. Tech discretionary being the primary drop off with the inflation, with the interest rate environment. Industrials, eurozone for obvious reasons. U.S. dollar down there too. Anything sticking out here?
Yeah, I mean, I find it interesting that the biggest. I find it interesting that the ground zero for the initial kind of crashing move, with the realization that rates were going to be going much higher. If you go back to January, February, March, um, it was the so-called long duration technology growth plays, right? And
Right.
if you've got everybody really confident of a turn in rates, it's really interesting that you don't have a lot of kind of like value speculation there.
Yeah.
You know what I'm saying? Like you've got this, it's the other side of the same coin, but tech is still shunned. And if you look at like, like the ARK stocks and the ARK ETF, like that was really kind of like you've got these long duration plays that are just, that are going to be so interest rate sensitive when long term interest rates go higher because it's going to be forever till they're really profitable. I mean, I wonder where the threshold is for rates where it starts to spur that speculative point again. I mean, look at the ARK ETF is down from 160 to 33, and it's on the verge of new lows right now.
Yeah.
It's
Yeah.
interesting. It's with
No,
rates turning around. It's interesting. There's
nobody looking
not
to
any
buy
kind of
them
close.
outside of Kathy Woods, right?
Yeah, right. Well, and there's a
Prepare.
reputational problem there for sure.
Yeah.
But still, that was the sort of equation with these things. Rates go higher, they have to go down. Now everybody's super confident in rates going lower and bonds being the best thing to be in over the next few months. And there's nobody fishing around in those. Kind of interesting.
Yeah. Something worth keeping an eye on for sure. All right, emerging markets emerging here, Brett. The percentage say that they are overweight. Emerging markets that popped to 13% overweight from 9% underweight. This is overweight for the first time in 9 months, which marks, of course, around Ukraine and the highest since June 2021. You made this call a couple of months ago. Do you expect this to continue
I do.
as the dollar goes down? Okay, tail risks. Number one, obviously, inflation stays high. We've talked plenty about that. The deep global recession, which, those two, you could probably combine the two together. Central banks stay hawkish. So that theme on the top three all kind of run lock and step there. Geopolitics running a relatively distant fourth, and systemic credit event doesn't look like anybody's expecting that just yet. But obviously, if we get the first three things, then that raises the aspect of number 5. So pretty much
Yeah,
in
number
line with,
four, I would say.
yeah. No,
I mean,
that's
I would
fair.
say these things are all
All tied.
attached. Yeah,
Yeah.
there's a good world and a bad world. This is the bad world.
So the
All
tail
those
risk,
things
the
happen.
tail risk is a bad world, right?
Yeah, there is bad world, right?
Yeah.
Exactly. I mean, you've got no tools to battle against a downturn. Everybody gets angry and starts shooting at each other, and the banks collapse.
Yeah. So
That's a
uh,
bad world.
That's so this is the bad world scenario, we'll call it.
Yeah.
Moving along, just risk appetite part two here. That percentage taking higher than normal risk levels. As we can see, that's moving its way back up. So we had already discussed that. And then that just kind of brings us in. I just wanted to point this out in terms of the activity that we're seeing this week with all the options that are expiring. Now, this is September data, so it is a little bit older, but I just kind of wanted to put into charts what Brett and I were talking about earlier as well with that options expiration. So we just had this kind of at the tail end of the discussion here. You could see a big pop up in index calls, which builds off of that Goldman Sachs discussion that we had. And then finally, just options positions when you compare it to futures ETFs. I mean, this dwarfs ETFs. So that's just one of the things that we wanted to kind of keep in mind when we're watching some of this activity and why things don't seem to always match up. All right, Brett, final discussion here. Some of the key 2023 themes. Now, we've touched on a lot of them. We'll just kind of tick them off as we go along here and end the discussion. Recession talks, hard, soft, none. And the question is it priced in? Where do you kind of stand on this? And I know you're kind of just, you know, everybody's got an opinion on this one. Do you have any thoughts?
I mean, I suspect it's not priced in and will happen, but the sentiment data always has me cautious because it feels like there's so many people who have the same opinion, and I just hate that feeling.
Are you leaning more towards a deep recession or kind of like a rolling soft recession where we see different industries under and it just kind of lasts longer, which for you would probably be the most miserable thing in the world? Because I know your trading style, you'd much rather see a hard landing that creates volatility and different, bigger overturns in
Well,
asset
wouldn't we
prices.
all? I mean, who wants
Yeah,
the long, slow,
nobody.
dull point? It's like being killed by a spoon,
Exactly.
you know?
Exactly. So that's obviously one thing we're keeping an eye out on there. Value versus growth. Where are we in the cycle? I would say we're probably still pretty much in favor of people looking at value over growth. Would you agree with that?
I would say we're cycling back to that. Yeah.
Yeah.
We've kind of
Um,
had a little spurt toward growth, and now we're
yeah.
if you look at the value growth ratio chart, which I track all the time, we've kind of gone in these waves, and it seems like we're tipping back toward value leading.
Yeah, I was looking at a chart where I was talking old economy versus new economy, and if you look at that asset allocation, the old economy still has plenty of catch up to do. Stocks versus bonds, we've talked a ton about this. Brett, anything to add for closure?
I guess people think right now the 60-40 is back, but with maybe 50-50 or 60-40-60. But the
Right.
idea of risk parity as an overall strategy is back. I think that's the big difference. It's not about whether it's 60-40 stocks to bonds or 40-60. It's about the fact that it's not 30-30 plus 40% in cash or something. Like there's now the idea that one is a hedge for the other again, which is hasn't been the case all year.
All right. Dollar dominance. We've talked about this obviously on the decline. Can it continue? You remain a little cautious on the dollar at this point.
I
So
think the dollar has topped for this cycle,
yeah,
which is why the exposure I have it, and that was my my sense, that
right.
we'd get that Thanksgiving timing for seeing that shift.
Then energy capacity constraints, we addressed that earlier. You see some nice potential opportunities in commodities
Longer term, structural
longer
time
term.
frame. Yeah, I mean,
Right.
I think that like if you see a lot of weakness in let's say we see a global recession next year, it's a little deeper than we think. We see commodities really dive. Like I think that's got to be just. I mean, it makes me want to, go out and open a bunch of copper mines myself.
Yeah.
Like I mean, like that's like there's the moment.
Especially since alt energy, semis, housing, they all are undersupplied and need
And when
copper.
then we haven't invested in any new production at all for
Yeah.
fossil fuels or copper for
Would you,
years.
do you like Freeport as a play in
I
2023? That's one of
guess it
my
fits
top
into
plays.
that.
Yeah.
It fits into that. Yeah, fits into
All
that
right.
basic idea.
China reopening, we discussed this, whether or not inflationary, disinflation, or deflationary. The constrained emerging markets in terms of how does a global recession impact it. What do you see as the bigger driver, the weaker dollar or the global economy there, Brett, for
Well,
emerging markets as you're in
y-
there?
yeah, I mean, I guess, um, these things were just destroyed, right?
Yeah.
Like they've been, like a lot of the emerging market areas just been, it's already been through hell and back. And we got down to, like valuation levels, however you want to look at it, that are just historically low. And really, like, you come into this environment where the Fed is tightening money. It's harder to get dollars everywhere. There's a lot of dollar denominated, external to the US debt that just, is immediately at risk of default because they can't print dollars. And then you've got the war in Ukraine. You've got, I mean, all those resource shortages hit the emerging markets the worst. So this was all like a perfect storm 8 months ago for this area. And it's just kind of played through from there. I'm not sure that if the US goes in recession, it's going to compare with what they've already been through.
Okay. Meaning that it won't be as deep.
Won't be they will be less hard hit, I
Yeah.
think, than some of the developed world stocks.
All right. Then growth risk versus policy risk. What kind of pain do you think that the Fed would need to see before taking the foot off the pedal, even if they haven't hit that inflationary number?
Uh, I mean, so what's the thing that they're going to flip
If
on?
we're in a stagflationary environment, do you see them flipping it all on that?
Well, okay. First of all, let me answer the question I want to answer, which is, what thing would they see to cause them to completely flip? And that, I think, is a
Yeah.
hockey stick in the unemployment rate.
Okay.
I think that's it. I think that's the one. Like
They,
that is
they
such a
get
decisive.
that, a decline in hourly earnings, perhaps in a jobs report,
I
and then
think I think it's the historical. Like, if you look at the unemployment rate over a very, very long term, there's a way you can do like a Bollinger Band chart. Like, there's other studies that have been done. This isn't mine. I didn't make this. But there. I mean, it's you can there's an inflection level that is decisive. You're never going to get that, and then it just goes right back down. Like, there's a level of shift in the unemployment rate that is extremely trustworthy in terms of where things are headed. And I think Powell has even mentioned it before. I think that's the one factor that would just cause a complete change. That right there. You've solved the service sector inflation, you solved the wage growth, you solved everything in one shot at that point, and you're not really at risk of inflation expectations metastasizing, and they can completely shift their policy bearing. So I think that's a lagging thing. That's one of the problems, like we talked about at the beginning. So we may be well into recession before that happens. That's if you want the sort of bear thesis right now,
yeah.
is just like we talked about with people who've made a lot of recent hires and they've invested in training new employees. They think
Well,
maybe this is going to be a
that's my concern. The fact that
yeah,
they'll just
right.
kind of hold on to them for
They may be
dear
like, I
life
got to
and then
weather the next
throw in
four
the
to
towel.
six months, but I'm not going through this
Exactly.
problem again.
Exactly.
Yeah, so you got to break the back of that, and but at least the first thing it should break is wage growth.
Yeah. Europe's winter. How are you viewing that in terms of energy prices, geopolitical relationships, and stuff? Are you concerned about that?
Well, so as we talked about before, this was a major part of my whole dollar thing. Like, I thought the fears about this peaked in the spike in the dollar that we had in front of Thanksgiving. In Where was it? So we had, I guess, actually, back in September, October. So as we're coming to the fall, and we talked about this in one of our strategy meetings, that people are going to start to see this idea that you're going to have just this devastating winter in Europe, where Putin is going to pull natural gas right in the middle of a super cold spell. They're not going to have the energy to keep factories open. It's just going to be post-apocalyptic. And that kind of flooded into really extended kind of the last wave of the dollar. And it's not looking as bad now. So we've started to see that temper. We've started to see some of that money come back out of the dollar. But I think that it was
I
this.
think a lot of the European countries did a good job at getting their supplies up to
Well,
the levels needed
this is
too,
how
right?
people react, right? I mean, like you see the worst case scenario, and it very rarely happens because
Right.
people can change.
Although it is interesting to see Putin attacking all the energy infrastructure for the Ukraine just before the winter, obviously setting up, trying to kind of choke them out in the cold to
Yeah.
bring them to the negotiating table. It feels like.
Yeah, but it's interesting to see the resolve. I mean, it seems like
Yeah.
that's only hardening the resolve from what I see in terms of every piece of influential commentary that I come across at this point. It's just resolving toward more and more the entire kind of civilized, reasonable world saying, okay, we can't have some kind of land for peace deal here. We need to basically arm Ukraine to completely win.
Yeah, which is interesting to see how long
That's
the
a
money.
transition, right? I mean, like a month and a half ago, it was different. Like,
It's a
let's find a way to
transition,
peace.
but the problem is I don't think that that's completely in the mindset of a lot of countries yet. I mean, certainly uh, the Baltic states are firmly behind that and everything, but you're already seeing signs in Congress, right, in the U.S., where people are raising questions about how much money we're sending to the Ukraine, and are we just going to make this an endless pocketbook for them and everything?
But
And
what problem are you going to have if you don't?
no,
I mean, if you
exactly.
like,
I'm
you're
all
just going to
for
have new
arming them
Hitler.
personally, but yeah, I mean, it is well, don't forget Hitler got pretty deep before people really started to finally kick up. I mean,
Well, we've got that lesson.
Hitler got a couple of swaths of land first before he
Yeah.
did that. So, but I'm
I just
just,
think it's interesting. They get nastier, and rather than it making people more likely to capitulate, it seems like it's having the opposite effect,
which is
from what I
good in
can
my
tell.
opinion. Yeah.
Sure.
So, but I'm just curious to see how Europe's winter, especially if it's a cold one, how it could potentially change the geopolitical landscape. And then the final thing, just Bank of Japan, Kuroda steps down after 8 years in charge there. I know you followed the carry trade in the past and everything. Uh, Japan's always an interesting economic aspect, given the central bank activity over the last 40 years now.
Yeah.
Third largest economy in the world. I don't know if it's still there though at this point. But you got any thoughts about BOJ under new leadership? Do you have any interest in
I
the
think
yen
it's a
at all or
huge.
anything?
I think it's a huge wild card because, like, it's 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 been remarkable for me to see how slow they are to react to the context that we see now. But they do have a very different culture. It's just one that feels to me like it could shift on a dime, and they've got the opposite problem that they've had for a while. And I think that if you get new people involved, that paradigm can change, and it's going to have an enormous effect. But it would be, I would suppose, the immediate effect would be a stronger yen, which is, I don't know how. I don't really know where this carry trade stands in terms of the yen's percentage participation. I would assume it's still very, very high.
Yeah,
And if
I
that's it,
feel like it's gone in waves where uh,
certainly has.
like a
And
couple of
now it's
months ago
crashed
it was being
completely.
unwound,
Yeah.
and
So I
now
mean,
now you see it coming back, given everybody else rising, right? But
yeah,
now if
you could,
Japan's rising, that
yeah.
should unwind it.
Well, that's the question, right? I mean, you can borrow lots of yen and use it to speculate on all sorts of stuff. And if you suddenly get a paradigm shift into a different paradigm in terms where they're going to draw their lines. And this has been the most accommodative central bank in world history for decades. And if that shifts on some level, because somebody just has a different view about this inflationary environment and Japan really not being able to produce any raw commodities and they got to import everything, um, long-term commodity price expectations come into it, all sorts of things. It's not impossible that you see a different philosophy there, and if there is, then that would be a kind of broad, probably not too sharp, but a broad deleveraging factor in all sorts of other assets.
All right. Okay, Brett. So that's going to do it for us over here. Last question for you before we let you go. What are your thoughts over the next, 24 hours here? Are there any trades that you're eyeing up? I know it's quadruple witching tomorrow, which always provides a little bit of a tougher read on the markets given some of the actions that go on with that expiration. But are you eyeing up any potential trades here?
Yeah, I mean, if I just see the right level of consolidation, I'd like to short down to 38.70.
All right. So
But I want to see, I want to see where I can measure my risk. And it's been, if you don't catch it right away, um, I'm looking for a where I understand where my falsifiability level is. I'm pretty, structured in how I gauge my setups.
right. So right now you'd be leaning lower though at this
Yeah,
point. Yeah.
right.
Yeah, I'd agree with that. Maybe let some of that activity pass. PMI's out tonight and tomorrow. Expecting to see a pretty negative commentary from them there. So I'll be curious to see how that impacts the market expectations, but it'll probably just lead to greater consternation around a global recession, which we've certainly seen following today, the reaction to today's data. So, all right, Brett.
Here's one other question for you: is tomorrow the end of the year?
This is like in terms of does the Santa Claus rally kind of come
Well,
into
no,
play
just
there?
is tomorrow the end of the year in terms of macro uncertainty factors, headlines.
Macro, yes.
Seems like it is,
There
right?
are three things next week that I think could factor into trading: Micron, Nike, and FedEx earnings.
Okay.
So they're three pretty big bellwethers, and that could certainly have an impact, certainly on their prospective industries there. FedEx, of course,
I guess this
probably
Fed
being the
speak
best read.
popping up.
Fed speak will be popping up. I think we got a fair idea of what to expect from them. I'm expecting a continuation of the hawkish commentary that we saw from
When does the
Powell.
debt ceiling become an issue?
Debt ceiling has been taken off. The omnibus bill was signed. I'm not sure if it's
No, I know they
signed
took
yet.
it off for now, the lame duck. But I mean, obviously a month and a half ahead of
It was
time, it's going to become.
it was extended to September 30th, I thought.
It was
And
extended to next September.
yeah, so the next budget period, which
Okay.
means that it's a
So we're
non-issue
right.
for,
Yeah, I didn't realize
for
that.
yeah,
That's great.
yeah,
All right, good.
that's been taken off the table. They did it in this lame duck because they know it's obviously going to be a lot tougher next year when you have a
But I thought
GOP-led
they took it
House.
off of the agenda for the lame duck.
My understanding
How
was
did I
they
miss
signed the
this?
omnibus bill
They
and it
put it
was
back
through to
on.
September. I could double check with Carmine on that, but I'm pretty
Okay.
sure
I know
that's been
you
taken off the table.
probably know
So
better than me right now.
yeah, so
I've been
so
half I've been half here for 2.5 months. So
yeah, yeah, that should be off the table, and we should be able to move forward without worries on that
I
until
see a one
September.
right now, a missed opportunity on debt ceiling.
Let me double check with Carmine here, see if I can get him. I thought I saw an omnibus bill.
I know that they were going to do it, but I thought they said, we're too busy, we don't have the time, it's the holidays, and they took it off.
That could be it. I thought that they had gone through with it and taken it off the table. Let's just see if Carmine will hit me up.
All right.
All right, he might not be around, so yeah, he might be gone for the day at this point.
Well, we can post on it.
Yeah, we'll post on it. But all right, so just kind of in closure. Hold on, I'm seeing that they're expected to
Okay.
clear it next week.
All right.
Okay, Carmine's saying the media will make a big deal out of it in June when it comes up, but they don't have the votes to block anything. There will
Okay.
be a lot of noise, but nothing will happen. This is how he sees it. So
Okay.
he's usually
Good.
pretty right on. So that should be one factor off, leaving us with only 500 other factors to worry about there,
Yeah,
Brett.
and for the comment that just came in feedback, that I was talking about the futures pricing when I said the 38.70 to 38.75 area.
Yeah, the continuous contract there.
Right.
So all right. So Brett, then in closing here, from my perspective, I'm not seeing things at complete extreme bearish levels, given some of the changes we've seen in sentiment and positioning, but it obviously remains firmly in the bearish territory. Valuation remains a concern out there for the markets, and obviously the big one is the fears around recession and how that's going to impact things moving forward. So definitely looking to close 2022 out in a pretty rocky situation. 2023, everyone's looking at that the recession to come in. So it's going to be interesting to see what breaks the temperature on that. But there's definitely position on the sidelines that would allow for some buying. So from my perspective, I'm kind of expecting. I still think that we could get a bit of a Santa Claus rally going into the end on seasonality there. That has obviously been brought into question with the Fed and the econ data that we got this morning. But again, the sentiment and positioning does lend us to possibly seeping a little bit higher from now, but we're going to need some technical improvement on the charts before any of that goes through. So that's kind of how I'm looking at the end of the year and into next year, going on a cautious footing with keeping an eye on some of the cyclicality in different areas. What would you say is your big takeaway from this discussion and you're looking forward for 2023?
So I think the stage is set for the possibility of some kind of support and a rally, but you'd need some, I think, some new factor to enter the equation. If we don't really see anything shift about the picture that we're dealing with right now, it's a really difficult technical picture. That broadening triangle is a broadening topping pattern. We already see the Nasdaq under its 50-day. So I guess I'm leaning toward looking for short side patterns and looking for a pick back up of volatility into the end of the year and into the beginning of next year at this point. If we get something that shifts the picture, you've got a lot of people who are holding puts. You've got a lot of people who are in cash. It's certainly a foundation is laid there that if we see something materially shift the picture, that there could be a huge scramble the other direction. But without that, without some kind of factor, without some kind of catalyst, I think that things will erode.
All right. Brett, thanks as per usual for joining us here. Always fun having this conversation. We have this tape, so I'm going to be posting it shortly to the site. I am going to shut down audio temporarily here just to end the recording, and then I'll be jumping back on in a couple minutes. So, Brett, you take care of yourself. We'll be talking to you soon. I hope your recovery continues as you get deeper into the holiday season and get ready to play Santa Claus for the triplets and everything.
Yeah, right. All right. Hey, take care, Gav.
All right, you too. Take care.